Thanks for tuning into this earnings conversation with Dr. Satyanarayana Chava of Laurus Labs. The quarter results came out yesterday, and a bunch of questions around, of course, what went in the quarter and what the outlook could be like, even if not in exact guidance terms. Dr. Chava, good having you. Thanks for joining in.
Good afternoon, Neeraj.
Very good afternoon to you, sir. You had started, and I've noted it down, you've started the last quarterly interview with me saying that the environment was challenging. But did the challenges that came up, for example, in CDMO, and we had spoken on the 30th of Jan, if I'm not wrong, did the challenges that come up in CDMO, for example, kind of come out of the blue, or were these partly anticipated by you as well at the end of Q3? Because clearly that is that one piece that has not worked in your favor in the quarter.
The CDMO business is more of an opportunity than a challenge. See, we are not looking at CDMO business quarter after quarter. See, the CDMO business is bumpy, and people are very happy with our offerings. We have added new clients, new big pharma clients. We secured clinical phase orders from big pharma. So that segment is very exciting. See, if that segment is not exciting, why we invest 900 crore Capex last year in augmenting our capacities? Yeah. Why we also commit to invest another 900 crores, majority into CDMO? See here, for example, we started dialogue with our animal health partner in January 2020. And we are starting commercial manufacturing in the second quarter of FY24. And the commercial revenue will come from Q3 FY24. That means it took almost 4 years from the dialogue to commercialization. This is the kind of business we want to get in. So the gestation period is longer, but the quantum of opportunity is much bigger, and it's more predictable. For example, in some of the CDMO, what we are investing, we know what capacities we are creating, for what product, for what customer, and what price. So there is a lot of confidence and predictability right now in CDMO business. But we can't scale up the CDMO business next quarter. But we have great visibility on that segment.
Sure. Okay, so I'll qualify my questions, Dr. Chava, and that is from a perspective of, yes, there being a long-term promise, but what happens in the near term? So one of the brokerages says that Laurus expects improvement from the second half of FY24, but the base business growth may not be that great, and no big CDMO product to fill the void left by high-margin Paxlovid and unused capacity could result in lower revenues and pressure on margins.
The biggest drag for our expectations in FY20. See, if you look at FY20 to FY23, we did grow by more than 20%. But below what we thought, below what market also expected. That was not because we haven't done well in synthesis. We haven't done well in generic ARV APIs and generic ARV formulations. That was a big drag. Now, that was almost done. So we don't expect that will drag further. For any actions to get results in this regulatory environment, what I mean regulatory environment, all our sales happens to regulated market, highly stringent regulatory agencies market. Any change, even cost improvement, vendor change, process efficiency improvement will take its time. And for us to have a strategy to have improvements and implement, get approvals, will take 6 to 9 months time. We have done so many measures, and those will give results in the coming quarters. That's the reason we said worst is over for ARVs.
Yeah. Sure.
So the biggest drag came from ARV volumes as well as prices. Both we were hit by two sides of the knife. So prices as well as volumes. Otherwise, we could have done far better than we anticipated. But that is the market situation. We have to take it, and we have to have a strategy in place for future. You can't undo past. So we have done some measures. Those are definitely good, and we will see benefits soon. That's the drag last year. But this year, as everybody is seeing, we have a large CDMO base. And since we stopped giving guidance, we leave it to the analysts and investors to make their own models. The reason why we wanted to say that what is in our hand is our customer visibility, project visibility, and how much Capex we need to put. That's where So we are very transparently saying how much Capex we're putting, which Capex is going to which segment. That should give a lot of confidence on why Laurus is investing in Capex. So without Capex, without having manufacturing blocks, we can't attract customers, both in human health, CDMO, or even generic CDMO. People wanted to have solutions tomorrow. They didn't want to have a solution next year. So that's what we are trying to do. At the beginning of the year, we have confidence on what is in front of us. At least we know the ARV API volumes are picking up. The ARV formulations volumes are picking up. We are getting some approvals in Europe and Canada. So things are, I would say, comfortable. And we are not worried on the future. We are very, very bullish on the future. We will not quantify, but we are recruiting people. We are putting more manufacturing blocks. Things are in a good shape.
Okay. So yes, I do not want a guidance from you, Dr. Chava, because I completely appreciate the fact that you do not want to give one, and I'll stick by that. I would just love to understand the texture. Now, what I mean by that is when I look at the quarterly numbers as well, generic formulations, ARV sales have all shown an uptick. And I buy your point that you said that FY24 will be a year of consolidation. So let's assume on the revenue front, there is no problem. The question that I have about the texture is that if high margin, for example, quote unquote, Paxlovid or whatever else is not going to be a part of FY24, on a number on the revenue, which is circa 6,000 crores or between 6,000, 6,500 crores, could the operational metrics be closer to the exit rate that you had in Q4? Could it be closer to the average of 25, 26% that you did for the year? Could it be higher than that?
You know, in FY18, our EBITDA numbers closer to 20%. We graduated slowly to over 30%. And if you look at the average for FY23, also about 27%. But the Q4, if you look at this, we went down to 21.
Yes.
We believe with the measures what we have done, this number will go up. It will go up gradually in the next 8 quarters. We hope our aspirational number, as we discussed earlier, is 30% EBITDA. We need 6 to 8 quarters to go there.
Got it. Yeah. Okay. But in the intermediate period, Dr. Chava, if you're in an ability to comment on it, one, would 21% be the base, or could you go below? Part one. And two, while you reach the aspiration number or higher than that in 6 to 8 quarters, in the intermediate period of 4 quarters, which makes up FY24, would the numbers worsen from here, or will they kind of stabilize at these levels for the next 3 or 4 quarters?
It will improve.
It'll improve.
For the entire year, I'm sure it will improve. Otherwise, if you don't improve in 4 quarters, there is no miracle one which will give 20 to 30%. So gradually it will go up. We don't expect for the entire year the margins going down.
Okay, fair call. Yeah. So somebody was talking to me about this, that a year of consolidation Would it mean a flat to decline of 10%? Because along with the lower margin levels, it could lead to a substantial decline in profitability. I'm guessing that's not the base case that you're making from where you are right now in FY23. I don't want a guidance, by the way.
So your point is valid. So since we are not giving guidance, people ask 4 questions around that and try to judge the guidance around that. What we can say is a consolidation here. We don't expect the revenues to go down.
Okay.
That's the one I can give you. And as I explained, the margins will inch higher than what was there in Q4 for the whole year.
For the whole year. Okay. You mentioned that the recovery will be from the second half onwards. What within the buckets that you operate in would you believe will lead this? Because we're seeing some green shoots, like I said, in ARV and formulations in this quarter itself, when I look at QOQ numbers, right? So does that train continue, so to say?
I think first 2 quarters, the ramp up will primarily come from ARV. Actually, I would say APIs, including ARV, Onco, non-Onco, and formulations. The second half, more uptick will come from CDMO.
Got it, sir. In the earlier interview that we did about 2 weeks back on Insight, wherein you explained this whole piece about how in CDMO, the success comes from a company creating capacities first and then getting people in, because clients want there to be ready capacity. So you explained that very well to us in that and a previous interview. Just trying to wonder, could capacity utilizations for those set of assets consistently come under pressure, Dr. Chava, periodically? Not consistently, but periodically. It can well happen that you have your clients and therefore FY25 will be a very rosy year. But if it's a 2-year, 3-year contract and then you build more capacities, could there again be a lumpiness in the utilizations and thereby the operational metrics of those assets?
I think it is a catch-22 situation. Yes. Since our base of EBITDA is significantly large, it is not, although we did 1,594 crores, close 600 crores, it's not small number. By adding capacities, if the number is dragged by 100 crores, we are not worried. The reason is capacity creation, qualification, doing batches is a 18 to 24 months time period. And in 24 months, clinical program will advance from one stage to another stage much easier. So that's the game we are in right now, and that's paying well. We have added several big pharma clients in the last 2 quarters. When we were adding, we didn't get the commercial orders, but they added us into their supply chain, which we were not there in the supply chain. That's the first step. And then the ramp up will happen gradually because even they wanted to move faster, it will take several quarters. So the good thing what we are in right now is we have the ability to allocate resources, both men and material. So we can allocate hundreds of scientists if there is a customer projects are on a fast track. We can also allocate hundreds of reactors if there is a project needs significant reactor work. That's the place we are in right now. That's a sweet spot right now. For that, we have to bear some pain. Okay. Because the 2 million liters reactor volume we created in the last 18 months, we are using 10%.
Got it. And you reckon some of that might start to get utilized starting second half based on the conversations that you are currently having?
Yes.
Okay.
And currently our capacity utilization in API is around 55%. It used to be 75%. Right. It's not that we lost market share, we added more capacity.
Yeah, sure.
And by the time we utilize these capacities to 70%, I'm sure we need to build more. We will bring it down to 55. See, those why we do that? That's the, if you're in clinical programs or in the validation phase in generic APIs, by the time we go commercial, we need significant capacities.
Sure. Okay. A word on Capex in this uncertain world, Dr. Chava. What some capacities have already come on stream. I remember you were telling me that FY24, when earlier you had believed that it could be a step-up year of sorts, now you've qualified it as a consolidation year. But one of the reasons was that capacities were coming on stream in a big way in FY24. Can you tell us a bit about what is coming on stream? Are the timelines still intact, or could there be some delays, so to say? Because almost every management that I speak to is talking about some bit of delays here and there in the capacities because of supply chain issues or otherwise, even now.
Our API capacity additions were all completed. So there is no ambiguity in capacities coming online. But we will use it gradually. In the formulations, we already qualified additional 5 billion tablet capacity. We'll start utilizing from beginning from this quarter itself. And will we go to 10 billion? I don't think so. By end of the year, maybe we'll utilize 70% of formulation capacity, not beyond. And again, we are investing significant Capex in FY24. We are qualifying an animal health facility right now, and it will go fully commercial by end of this year. We are putting multiple blocks. Block 1 will put into commercial use July, block 2 by October, block 3 by March. And we're also putting block 4 that will come next financial year. So these blocks are built, purpose built for a product and volume. So there is no ambiguity. So our animal health revenues will kick in from second half of this. We are putting 250 crores on a dedicated R&D for CDMO. That will come online by end of this calendar year itself. That may not add significant revenue, but add significant capability expansion to take more early stage projects. Right now, we have a challenge to take more early stage preclinical and phase 1 because lack of resources to do that chemistry. That will be strengthened by end of this year. And we will start putting commercial manufacturing block for our agrochemical, which we just concluded an agreement. So this year, most Capex is going into CDMO, but we have maintenance Capex in across all our units.
Got it. You're almost painting a picture, Dr. Chava, of a company that is in a transition to having capacities which are of niche capabilities, higher predictability, and much better operational metrics starting FY25, maybe middle of that year and not at the start of the year, but something like that.
Yeah, see, this is the investment we did, and without investment, I'm sure we will not be able to attract any big pharma. So big pharma need both softer and harder assets at disposal. That we are geared up. And once we move out of this transition phase, I think then we not only we, outsiders will also see. Right now, as an insider, we are very bullish. We see what is in front of us. But when outsiders see that, when we start delivering numbers, when these capacities go online.
Yeah, well, Dr. Chava, I think the reason for the outsider to feel a bit disappointed is by virtue of the fact that there was so much promise, even in that intermediate period that you're talking about, right? There is promise at the end of the tunnel, but in the intermediate period of the tunnel, there was so much promise about the kind of numbers that could come about, and therefore the lofty expectations that got built when your market cap hit the levels that it did. And then the decline that has happened, that is probably what leads to some disappointment for the outsiders, as we call it. But
as an insider, we're also disappointed.
Yeah, I'm sure you are, sir. I'm sure you are relative to relative to what you set out to do and the timelines that you have?
Before market was disappointed, market was bullish. I'm sure we will see the same year. We were disappointed, market was disappointed. We were bullish, market was bullish. So we see first the pain of success much earlier to what investors can see.
Most certainly, most certainly. One quick question, Dr. Chava, before we wrap up. In the month of March, there's a note which spoke about how exports for the space at large and for you as well grew sequentially in March, and 16% growth on a YOY basis as well. Tell us, are the global markets in some terms of demand stabilizing, and would that aspect continue to remain a bit of a constant?
You can't deduce anything from that number.
Okay.
It happened.
Okay. Fair call. Dr. Chava, my final question. As an entrepreneur now who is seen 3 very interesting years, in that it was COVID hit, supply chain hit, and then relative to what you had guided to, there were some misses as well. What is it that you're looking out for the most when it comes to FY24 as a year? I know we are in April, almost at 28th April, but we're still at the start of the year. So as a financial year, what is it that you're looking for the most? Because you run multiple businesses, you wear multiple hats. What is it that you're looking for the most for FY24 for Laurus Labs?
I think improving efficiencies, process, sourcing, manufacturing efficiencies, those will drive numbers. See, in this industry, we will not be able to manipulate the prices, charge higher. Those days are gone. So we are putting more emphasis on improving our efficiency. That is in our hand. That's what we're doing now. This year, most of our resources, internal resources, we will spend on those, improving efficiencies.
Okay. A year of consolidation with improvement in efficiencies, hopefully improving utilization levels, and then at some point of time, without giving a number to it or without giving a timeline to it, a bump up in business starting to come. I'm guessing that's the template. And we, all of us out here, Dr. Chava, wish you all the very best for that and more. And thank you so much for joining us today and giving us your thoughts.
Thank you, Nilesh. Thank you.
I really appreciate it. And viewers, thank you so much for tuning in.